Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And while stocks in the S&P 500 did manage to break a 4-week losing streak, it doesn't mean investors are in the clear. In fact, with the stock market index still down 7.8% from its February peak and several catalysts on the way in April, the odds are that we see lower prices from here. That means even long-term buy and hold investors need an idea of where the market is heading and how to invest. So I'm laying out a complete 2025 stock market playbook. I'll show you what to watch for and signs of a stock market crash with the stocks to buy now and then at specific points over the next 6 months. Stick around and I'll reveal the stocks I'm watching this week, including important updates to Supermicrocomputer, UiPath, and the trade desk. First though, bonds are some of the safest investments out there, but with treasuries paying just 4.3% and the money market not much better, I've been investing my cash for a 7% yield on Worthy Bonds, a fixed income platform with bonds backed by small business and short-term real estate loans. You can invest as little as $10 per bond and earn interest on a daily basis. Best of all, you can withdraw all or some of your money anytime with no fees or penalties. Worthy even has a roundup feature that lets you invest your spare change on purchases into bonds, automatically building your portfolio. I'll leave a link below for more information. Make sure you check out their gifting feature. Give someone a $10 bond with just their email address, so look for the link below or just scan the QR code here. Back to our main topic though, and while last week did break a multi-week drop, stocks likely aren't done falling, and there are 3 key dates I'm watching for when stocks could plunge even further, even into a stock market crash. Now that's because up to now, the market has been falling on the fear of 3 factors here: tariffs, inflation, and federal spending, but could soon get confirmation of these that is much higher than feared and sends stocks down lower. I want to take each of these factors in order, reveal the dates over the next month that you need to be watching, and then stocks to buy for those 3 stages in this market. We've seen a back and forth on tariffs, with Trump delaying those on Mexico and Canada several times, while bumping China tariffs up 20% and instituting a 25% steel and aluminum imports. Even with the back off on some though, tariff rates are already much higher than we saw with Trump's first term. We're about to come into the end game with an April 2nd date on global levies. It's one of the major dates I'll be detailing later, and while some domestic companies could benefit, it's going to be a jolt to others. The CEO of Ford Motor Company bluntly stated that incoming tariffs would blow a hole in the U.S. car industry. And I separated the tariff factor from inflation here because while tariffs are expected to boost prices, they're also going to be a drain on the economy through the uncertainty and demand. We've already seen a lot of businesses pull back their spending in that wait-and-see approach for those final rates and to see how they're going to be affected. The nonpartisan Peterson Institute for International Economics estimates the combined effect from tariffs and deportations could hit the economy by as much as 9.7% through 2028 and a minimum of 2.8% over the next 3 years. The bigger shock from those tariffs, though, could be through that inflation. Businesses pay tariffs when they import a product into the country. If a business eats the additional costs, earnings fall, which is going to hit those stock prices. If the business, though, passes on those costs to the customers, inflation rises, which generally leads to lower spending that hits business earnings and hits the stock price. That same Peterson study found that the tariffs could spike inflation by at least 4% and as much as 7% over the next year. And up until now, the market has been so fixated on just these 2 factors, tariffs and inflation, that it's largely ignored the effect of government spending cuts and layoffs, but we could be about to see how this becomes an even bigger problem for the economy. Doge cuts saw overall layoff announcements jump earlier this month, and it's just getting started. The Trump administration has targeted to cut as much as 20% of the federal workforce and trying to find savings of $2 trillion in government spending. And so far, the market has largely shrugged that off because a 20% cut of the directly employed federal workforce would only amount to a loss of about 400,000 and a labor force of 151 million. But the true effect goes much deeper than anyone realizes here. The Brookings Institute estimates the true size of the federal government, when you include federal, military, postal, contract, and grant supported, is not the 2.2 million direct employed workers, but over 10 million jobs. And while we aren't likely to see an across-the-board 20% reduction, even a 10% of this would be a million jobs lost. And more than this, federal spending at about $6 trillion a year makes up nearly a quarter of the economy. $1 in $4 of the economy is driven by that government spending. I'll be the first to admit the government needs to be put on a fiscal diet, but when you take a hatchet to spending in just a few short months, you're going to see spillover effects. The roughly 1 million government jobs lost between direct employed, contract, and grants are revenue for companies through consumers and federal spending that's going to support millions of other jobs. And I'm not alone here in taking this logical conclusion. Danny Moses of The Big Short fame told CNBC last week that the market is underestimating the federal cuts and that it could create a negative shock to the economy. And while the Fed does have lots of room to cut interest rates that support the economy, that threat of inflation could tie the central bank's hands. Overlay inflation over the last few years with a historical chart, and it looks eerily like the stagflation we saw in the 70s. Back then, when the Fed backed off its interest rate hikes to support the economy in the late 70s, inflation reignited to double digits in the early 80s. That's something the current Fed wants to avoid, so we'll have to make sure inflation is beat before they cut rates further. With all that in mind, how should you be investing over the next 6 months? I detailed the Barbell strategy in February, holding half of your portfolio in tech and growth stocks that had done so well over the bull market over the last 2 years. Even if the market falls further, long term it's that tech and growth that you want to keep the exposure to and want to be invested in, so you'll be ready when the market does rebound. But then taking advantage of those lower prices means having some cash set aside, and that's where the Barbell strategy shines, because you've also got the other half of your portfolio in super safe cash, money markets, and bonds. Now I'm going to show you the specific investments later, but these are going to protect your money and give you that opportunity to pick up the discounted growth stocks before the market starts to rebound. And within that strategy and over the next 6 months, there are some important dates and market levels that I want to watch for clues. The first date is going to be April 2nd, the day reciprocal tariffs are set to take effect and when the Trump administration is going to lay out its plans. While we've seen other tariffs on China, Mexico, Canada, and steel put in place, this is the big one because it's potentially worldwide. The government plans on raising tariffs against each country commensurate with its tariffs it levies, which in some cases is extremely high. For example, while the U.S. average tariff rate is just 3.3%, India charges 17% tariffs, and South Korea charges 13% on its imports. In fact, among the largest trading partners with the U.S., all charge higher tariffs than we do. Now, as we've seen so far, there will be lots of back and forth, implementing, then pausing, or delaying as countries try to get an exemption or just negotiate, but tariffs will take effect and will be higher, and the market is likely to react negatively all that week to the news. I'm also going to be watching the April 4th monthly non-farm payrolls report, the jobs report, which is going to be the first to start showing the effect of government layoffs on the labor market. The 2-month average for this year is just 138,000 jobs created per month, well off the 167,000 pace last year, and it's likely to get much worse over the summer. This one and then the following few months, always reported on the first Friday of the month, is going to be the best clue into the direction of the economy and how far down stocks might go. Then it's the big banks that are going to start the first quarter earnings reports on April 11th, and I'm expecting companies to severely downgrade their expectations for revenue and earnings. Now, partly this is part of the game management plays with investors, lowering expectations so companies can later beat those expectations and management can get those hefty bonuses. But it's also the fact that companies are facing more uncertainty around consumer spending, tariffs, and inflation, and so will want to lower those expectations even more than usual to make sure they can beat those forecasts later. Right now, FactSet Earnings shows expectations for companies in the S&P 500 to report full-year earnings growth of 11.4% on 5% revenue growth, both of which are a pretty high bar and will need to be lowered. More than anything else, this is what's going to drive the biggest drop in stocks and that capitulation moment that could signal investors to start to buying back into this market. Tariffs and weak job reports will hurt the market sentiment and cause more uncertainty, but it's those actual forecasts during Q1 earnings season that is going to go into Wall Street expectations for lower stock valuations. As this happens over the next 2 months during that earnings season, stocks are going to sell off on the news, and there will come a time when investors just stampede for the exits. And that's when the smart money gets more aggressive buying back into this market. But exactly when that happens is tough to say. There are levels in the S&P 500 I'm going to be watching to gauge the market and when to invest again. If the S&P 500 falls back to 5532, that's going to be back down the 10% from its peak, that technical definition of a correction that we hit on March 13th, and then confirm the downward trend. If the index falls further to 5317, it's going to mark a 13.5% drop from the peak. That's going to be the average for corrections back to World War II. Now it's at that point, down to the average level of correction, that I'd start buying in some of the dip stocks that I'll reveal next. In data back to 1929, the average correction has lasted just 4 months, so unless we get a full-blown stock market crash, this should be a good time to start buying that dip. If the S&P 500 does fall further to 5,000 on the index, that would mark nearly a 19% dip from that peak and just shy of the 20% drop that is a technical definition of a bear market. I believe it's around this time that the Trump administration would start walking back some of those most market-unfriendly policies or just release plans to support stocks. While President Trump hasn't talked nearly as much about the market as he did during his first term, He still doesn't want to see a bear market to be one of his legacies, and he's going to try to avoid it. So now I want to give you an idea for some of the stocks you might buy during all of this, as the market keeps falling, when we start to see a market bottoming, and then on that capitulation before the market starts heading higher. Over the next month, I expect the market to continue to fall as we get a full view of those tariffs and the potential effect on the economy. We may not reach that capitulation moment that signals that market bottom until first quarter earnings wrap up in June, so you should focus on the safer ETFs that are going to help protect your money. These might include funds like the Healthcare Select Sector SPDR, the XLV, which benefits from relatively stable cash flows to healthcare companies, plus stronger earnings forecasts for this year. Within healthcare, you might also look to the major drug makers like Eli Lilly, ticker LLY, and Pfizer, ticker PFE. Another safety investment would be the Vanguard Total Bond Market Fund, ticker BND, which holds half of its holdings in U.S. government debt, the other half in highly rated bonds, which are going to see prices rise if those interest rates come down in the face of a weaker economy. As the stock market gets closer to that 5317 level on the S&P 500 index, that 13% average for corrections back to World War II, you might start picking up ETFs in the growth sectors. These might include the iShares Expanded Tech ETF, the IGM, my favorite tech-focused fund for broad market exposure, or the First Trust Cybersecurity ETF, the CIBR. Buying into those broader ETFs like these is going to get you exposure to those growth themes for an eventual rebound, but it's also going to protect your portfolio from any big single stock crashes as the market tries to find a bottom. And when it does look like the market has found a bottom, likely under the 5,300 level, but above 5,000 on the S&P 500, we can start to more aggressively buy into those growth stocks that have been the hardest hit. I'm going to highlight more of these in our Wednesday video on my favorite buy the dip stocks, but some great examples here include Arista Networks, ticker ANET, SoFi Technologies, ticker SOFI, and Symbotic Inc., ticker SYM. Looking at some of the stocks I'm watching this week, UiPath, ticker PATH, got hit on its fourth quarter earnings and is down 15% this year, but I highlighted it in Friday's video as one of Alphabet's stock picks and with some of the best potential upside. A miss on its sales forecast sent shares crashing even though the company beat earnings forecast, but Path is still expected to grow revenue by 7% this year to $1.5 billion, and a sell-off puts it at 4.2 times trailing sales and just 3.8 times this year's expected sales. That's a big discount to the historical average valuation. UiPath is a leader in business process automation, the kind of agentic AI where I think the next wave of artificial intelligence is going to take us, and these agent models built by Path, Salesforce, and even ServiceNow are just going to print money. The Trade Desk, ticker TTD, is one I'll be highlighting in Wednesday's video, another stock that has been crushed lately, down 52% on the year as worries of those consumer slowdown and a hit to advertising spend drives a weaker outlook. While the consumer and economic environment is likely to get worse through the summer, this one is just too cheap to ignore on a long-term potential, and I'm adding shares right now. Trade Desk is a leader in e-commerce advertising with more than 10% of its growing market. That digital ad market at $135 billion is still just a fraction of the $900 billion global ad market, so there is decades of growth left, and TTD is going to get a big chunk of that. Even on the weaker near-term outlook, revenue is still expected up 18% this year to $2.9 billion, which would put the shares at just 9.5 times on that price-to-sales basis, less than half its historical valuation. I'm also watching shares of Supermicrocomputer, ticker SMCI, has found strong support around $40 a share, bouncing back above that level anytime it's fallen over the last month. In fact, one of the most volatile stocks of the last year has become a relatively safety play in the market sell-off, with shares bouncing higher Friday even as the market dropped lower. The next big catalyst for upside should be the news on the Department of Justice investigation, likely a big nothing burger, and could send the stock towards $50 a share if that investigation is dropped altogether. First quarter earnings are expected April 28th and should be positive on continued orders for NVIDIA Blackwell chips into SMCI servers for those data centers. There's still a chance for some market-related downside as investors worry about that capital spending for AI and for those data centers, but this one is still very cheap on its growth, and sales expected up 60% this year and 38% next. This is a stock growing by almost 40% plus a year, trading for just 1.2 times on a price-to-sales valuation. Showing you that bigger picture here with the Sector SPDR sector tracker. 8 of the 11 stock sectors closed higher last week in a broad but not uniform rebound from the 4-week sell-off. Energy bounced back as a crude oil found support just under $70 a barrel and fighting resumed in Israel. Energy stocks are now the top performers this year, up 8% against that 3.6% drop across the market, and should continue to provide some safety even if stocks do fall further. Stocks in the healthcare sector also did well last week despite prices coming out of the other safe haven sectors like consumer staples and utilities. We've been watching those healthcare stocks for the last 2 months now up 6.5% and the second best performer after energy this year. The sector is now expected to post the highest earnings growth for the first quarter, with profits up 35% from last year. Within the sector, the pharmaceuticals and biotech industries are expected to post blowout earnings of 116% and 67% for the quarter. Favorites in the group include Merck, ticker MRK, Eli Lilly, LLY, Johnson & Johnson, ticker J&J, and AbbVie, ticker ABBV. Earn 7% yield on bonds from the Worthy platform, and the link I'll leave in the description below. Or click on the video to the right to see the 5 stocks that will replace your income. 5 stocks to buy now that will retire your job. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.